Okay, let's unpack this.
Yeah.
It is February 2026. And if you've turned on a TV or, scrolled any news feed lately, you know the script.
Oh, you can't miss it.
Not at all. The political talk is all America first. It's protectionism. It's all about securing our digital borders, keeping our tech edge right here at home. That is a very loud story coming out of Washington.
It's certainly the narrative on the stump, yes.
But, and this is why we're doing this deep dive, if you ignore the speeches for a minute and start looking at where the money is actually going, you see something. Well, completely different.
A huge divergence.
We're looking at a whole stack of investment advisories, internal bank reports, market data from Hong Kong, and they paint a picture that, frankly, just doesn't fit the political mood at all.
It's what insiders are starting to call the Great Migration of American capital.
Specifically to Chinese AI. And our mission today is to figure out why America's biggest financial institutions are pushing clients so hard toward Chinese AI, especially in a climate that seems so hostile to the idea.
It really is a case where the political map and the money map just don't seem to line up anymore.
So let's start with the sheer scale of it.
Yeah.
Because when I first saw the brief, I figured, it's a couple of hedge funds making some risky plays.
Right, a few outliers.
But that's not what this is.
No, not at all. This is a structural shift. And to really get it, you have to look past the AI label for a second and just think about the history of capital. I mean, this isn't the first time American money has flooded into China.
You're talking about manufacturing back in the 90s and 2000s.
Exactly that. Just think about why that happened. It wasn't about politics or ideology. It was just math. In the 90s, a dollar invested in a factory in the U.S. got you, say, 1 unit of output. That same dollar in Shenzhen.
Got you 10.
It got you 10. It was a gravity well of efficiency. And the sources we're looking at today are arguing that the exact same formula is now playing out in the AI sector. The argument isn't that Chinese AI is better, but that the return on investment, the ROI, is just becoming irresistible.
Okay, but hold on. Manufacturing is one thing, labor costs, land. But AI, that's high tech, it's talent. Does that same efficiency argument really hold up?
That is the trillion-dollar question. And according to firms like Goldman and Morgan Stanley, the answer is yes. But the efficiency isn't just about labor. It's about deployment speed, market adoption. The velocity of the money is just faster.
Let's get into that velocity then.
What?
Because the numbers in these reports they're not subtle.
No, they're significant. If you just look at the period since December 2025, so the last 90 days or so,
right,
we have seen over a dozen Chinese AI developers launch IPOs in Hong Kong.
And that's just what's already happened, the pipeline, the part in the JP Morgan report.
Yeah.
That's what really stopped me.
Right. The 2026 pipeline, they're tracking about 30 more Chinese AI firms that are currently in the process of listing.
30. I mean, let's just pause on that. In the U.S., we get excited if 1 or 2 big tech names go public in a whole year. 30 in one sector. That's not a trend. That's an armada.
It's a massive capitalization event, and that's why the smart money is moving. You can ignore a couple of startups. You can't ignore an entire sector mobilizing for public investment at this scale.
And who's helping them do it? Because this is where it gets really weird for me. These aren't obscure little banks.
No, it's the titans. The names on these deals are Goldman Sachs, JP Morgan, Morgan Stanley, Citi, BlackRock.
Okay, so let's name some names. On the software side, the brains of the operation. The reports highlight a company called Minimax.
Minimax is a perfect example. Their IPO was in January. And look, a Chinese AI IPO is one thing, but Minimax is being actively talked up by Goldman and JP Morgan in their notes to clients. They're positioning it as a true global competitor.
And right next to them, there's Zippo.
Zippo, also a January IPO. And this one is interesting. Morgan Stanley and BlackRock have both issued what they call high conviction buy recommendations.
High conviction. I mean, that's not dip your toe in, that's jump in now.
Yeah.
Why? The U.S. has OpenAI, it has Anthropic. Why would BlackRock tell its clients to pour money into Zippo?
It's partly diversification, sure, but it's mostly about growth potential. The U.S. market is saturated. The valuations are astronomical. The argument for Zippo is that its growth curve is just steeper. And you have to remember, they have a home court advantage in a market of 1.4 billion people that U.S. firms can't easily access.
A protected market.
Exactly. And for investors, a protected market is a very, very attractive thing.
Okay, that covers the software. But I love a good infrastructure story. And the picks and shovels section of this research was maybe even more bullish.
It often is. Software can be trendy, but infrastructure, That's sticky. You need the hardware to make any of this stuff run.
And that brings us to Byron technology,
Byron's a fascinating story. They make GPUs, graphics processing units.
the chips that do the actual thinking in AI.
Correct. And remember, the U.S. spent years trying to block China's access to high-end chips. The idea was to starve their AI development.
Right.
But it seems to have had the opposite effect. It force-fed their domestic chip industry. Byron went public in January, and J.P. Morgan note this value almost doubled right after listing.
Doubled. That implies the market believes they're good enough, that they don't need NVIDIA to power their own ecosystem.
Good enough to service the massive internal demand, absolutely. And the market loves a company that solves a bottleneck.
And chips need data centers. Which brings us to Shanghai Ilivatar Corex.
A bit of a mouthful, that name. But they build the high-performance data centers, and Citicorp is pointing investors directly at them.
Why them specifically? Aren't data centers just big warehouses with good air conditioning?
Not anymore, not for AI. We're not talking about storing photos. We're talking about training clusters that generate immense heat. The engineering for power and cooling is now cutting-edge stuff. Citi is betting on their energy efficiency, on the specialized real estate where the AI actually lives.
So if Minimax is the brain and Biren is the muscle,
Mm-hmm.
what are the nervous system? Suzu NovaSense.
Right. They make the specialized semiconductor sensors, the little components that monitor heat, data flow, everything. Goldman Sachs put them on their AI enabler list.
AI enabler. That sounds like a category made specifically to attract big funds.
It is. It's a signal that this isn't some flashy app. This is fundamental. You can't run the big models if your servers are melting. Wall Street loves these companies because if the whole industry grows, they have to grow too.
It's like the banks aren't just picking one horse to win. They're funding the whole racetrack.
It's ecosystem investing. That's the strategy.
And the ecosystem goes even deeper. I have to say, this next part of the research really surprised me. The application layer. We're not just talking about chatbots. We're talking about finding new medicines.
This is where the ROI argument gets really interesting. Look at In Silico Medicine. They IPO'd back in December. Their whole thing is AI-driven drug discovery.
Which is the dream for pharma. But why a Chinese firm? I mean, the U.S. has a huge biotech industry.
It does. It also has a very complex and expensive regulatory environment. The pitch from J.P. Morgan, who called In Silico a leader, is about speed. If In Silico's AI can identify and test drug candidates faster because of different data or regulatory environment, that speed is incredibly valuable.
So it's a bet on regulatory efficiency.
You could call it that. It's about shortening the time from an idea to actual revenue. And in biotech, time is everything.
And then you pivot from medicine to machines with one robotics.
Morgan Stanley's top pick in robotics.
Yep.
Humanoids, factory automation, you name it.
Which feels like it comes back to that domestic need.
It does. China has a demographic challenge, an aging workforce. They need robotics. So the government has every incentive to clear the path for a company like One Robotics to succeed. For an investor, that's a powerful tailwind.
Okay, I want to pull back for a second. We've laid out the what and the who, but we have to get back to the how. As in, how are these banks justifying this given the whole America First political situation we started with?
The elephant in the room?
It's the whole zoo. I mean, if you're a risk officer at BlackRock and you see the White House talking about tariffs and sanctions, how do you possibly sign off on a high conviction buy for a Chinese company?
You would think that risk would just shut this whole thing down, but the sources give a very blunt answer. It's a hard and fast rule in finance. Money follows money, not politics.
It sounds good, but what does it mean in practice? If the U.S. government decides to sanction Biren tomorrow, a U.S. investor stock could go to zero.
It's not that they're ignoring that risk. They're pricing it in. They are making a calculated bet that the sheer economic momentum of AI in Asia is now too big to be stopped by political friction.
So the bet is that the global economy is just too tangled up to pull apart.
That's part of it. And it's also a fiduciary duty. Look, if BlackRock's analysts believe the Chinese AI sector will outperform the U.S. sector by, say, 20%, they have a legal duty to their investors to try and capture that return. It's not a political statement, it's a financial calculation.
Fiduciary duty versus, I guess, national interest.
It's a tension that's always existed, but it is razor sharp right now. They aren't taking a side politically, they're just chasing the yield.
It's like capital has become its own nation. It doesn't have a passport.
It's a mercenary. It goes where the returns are highest for the risk involved. And the spreadsheets are all pointing to Hong Kong.
Which brings us all back to you, the listener. Because most people listening probably aren't managing a giant fund. Why should the average investor care about all this?
This might be the most crucial part of the whole story. It comes down to one word: Access. Think about the big AI names in the US.
OpenAI, Anthropic.
Right. Now, can you open your brokerage app and buy a share of OpenAI?
No way. They're
Oh,
private.
yeah.
Locked up by VCs and Microsoft.
Exactly. The velvet rope is up. So all this incredible value being created in US AI is happening in private markets, away from regular people. You can buy Microsoft and get some tiny indirect exposure, but you can't buy the pure thing.
But these Chinese companies,
Are having initial public offerings. They are listing on the Hong Kong Exchange, which international investors can access.
that's a fascinating irony, isn't it? The nominally communist system is offering more direct capitalist access than the American one.
In this sector right now, yes. And it changes the whole narrative for 2026. The race stops being about who has the most powerful model and starts being about who has the most investable model.
So if you're a retail investor who believes in the future of AI and wants direct exposure, the market is almost forcing you to look overseas.
That's the conclusion these advisories are drawing. They're telling clients, if you want to actually trade high-growth AI stocks, you have to go to Hong Kong. They're satisfying a global hunger that the U.S. market is choosing to starve.
It really reframes how you think about winning the AI race. We're so focused on technical specs, but maybe the real metric is how many people get to participate in the wealth creation.
And that leads to the big question. If American capital, and that means your 401k, your pension fund, is fueling the growth of the Chinese AI ecosystem because the returns and the access are better there, well, you have to ask something.
I feel the provocative final thought coming on.
I think so. The sources all suggest 2026 is a telling year. So here's the question I'd leave you with. If American money builds the Chinese AI machine, does the technology's nationality even matter anymore?
That's heavy. Are you saying AI is becoming a global commodity, like oil or wheat?
Exactly. You don't ask what country the oil came from when you're at the pump, you just ask the price. If AI becomes this global resource where the only thing that matters is the bottom line, then all the political talk about technological sovereignty might just be noise.
The lines on the map are being redrawn, not by governments, but by balance sheets.
It's a world where the dollar sign might be the only universal language.
Well, on that slightly unnerving but very illuminating note, we're going to wrap up. It's certainly something to think about the next time you hear a politician talk about winning the future, while your portfolio manager is quietly wiring your money halfway across the world.
Follow the money. It tells the real story.
Thanks for tuning in, everyone. We'll see you on the next deep dive.
Take